my name is Alex, and today I'm gonna tell you about cognitive biases that junior investors and traders do from second and third group. The second group of cognitive biases is of course related to personal decision making, but this time the signals interpreted wrongly come from the outer environment. Eighth in our list is fear of missing out, well known as FOMO, is the feeling of apprehension that one is either not in the know or missing out on information, events, experience, or life decisions that could make one's life better. FOMO is also associated with the fear of regret, which may lead to concerns that one might miss an opportunity for social interaction, a novel experience, a memorable event, or a profitable investment. It is very important to say that junior investors FOMO appears on peaks of market cycles when juniors see and feel which profit other investors gained. It's really hard to give in to this feeling even if you're aware of it. Ninth, ostrich effect. In behavioral finance, the ostrich effect is the attempt made by investors to avoid negative financial information. The name comes from the common but false legend that ostriches bury their heads in the sand to avoid danger. Ostrich effect is the example of fight, flight, or fright behavioral pattern. 10th, bandwagon effect. This is the tendency for people to adopt a particular opinion or belief simply because it is popular or widely accepted. This can create situations where people follow the crowd without critically evaluating the underlying facts or arguments. For example, my friends have invested in the asset tax, so maybe I need to invest in this asset a little too. 11th, halo effect. This bias can cause people to form a positive overall impression of a person or issue based on a single positive characteristic or aspect. For example, if someone is known for being a charismatic speaker, people may be more likely to approve their overall message or platform, even if they don't agree with all of their policies. The same is related to investment advices and financial forecasts. The third group of cognitive biases is also interesting and is related to inflated ego. 12th, always being right. Perfectionists and those struggling with imposter syndrome will recognize this cognitive bias. It is the belief that we must always be right. For those struggling with this bias, the idea that we could be wrong is absolutely unacceptable, and we will fight to the metaphorical death to prove that we are right. For example, the internet commenters who spend hours arguing with each other over an opinion or a political issue far beyond the point where reasonable individuals would conclude that they should agree or disagree are engaging in the always being right bias. To them, it is not simply a matter of a difference of opinion. It is an intellectual battle that must be won at all costs. 13th, mistake of generals. Bill Williams described this so that the commanders who has won wars in the past with a certain method most likely will lose new war using same old method because the principles of war has been changed. He says that such generals spend their life fighting old war. This mistake can manifest itself in people occupying high positions related to power. When they come to trading, they have a feeling that they can impact on market, as they impacted in their professional domain. These people usually realize this problem quickly and are able to fix the situation quickly. Bill Williams' discussion of the paradox of success in trading chaos highlights the importance of adapting on changing market conditions and being willing to update trading strategies in response to new information. This is a key concept in successful trading and one that is particularly relevant in fast-changing and volatile markets. As well, his concept is also right for traders who has destructive behavior during trading and they can barely do anything with it. Neurointegration perfectly allows to get rid of such habits and behavior. 14th, round number bias. One example of the round number bias in investing is the tendency for investors to buy or sell stocks at round price levels such as 50, 100, 500s. These price levels are often perceived as significant psychological barriers, and investors may be more likely to make decisions based on these round numbers rather than on other factors such as the underlying fundamentals of the company. To avoid these effects, market traders advise to sell and buy assets before psychological levels achieved by the price, and to not set goals on round numbers like 10, 50, 1000 and 5%, 10%, 50%. Another example, an investor may decide to sell a stock once it reaches a round number like 100, even if the company's financial performance suggests that the stock could continue to rise. Similarly, an investor may decide to buy a stock once it reaches a round number like 50, even if there are other stocks with better fundamentals available at lower prices. 15th. Declinism. Declinism can be characterized by a belief that things were better in the past and that the present and future are worse, often leading to a sense of nostalgia for an idealized past. This perspective can be rooted in a variety of factors, including changes in societal norms, economic instability, cultural shifts, and geopolitical events. Robert Kiyosaki has expressed views that can be seen as a form of declinism, which is the belief that society is in decline and that the future is bleak. Kiyosaki has been critical of what he sees as a flawed economic system that favors the rich and powerful, and he has expressed concerns about the growing gap between the wealthy and the rest of the population. Kiyosaki has argued that many people are unprepared for the economic challenges that lie ahead, and that they are at risk of losing their jobs and their savings as a result. He has also criticized that he sees as the overall reliance on government programs and the welfare state, arguing that these systems are unsustainable and will ultimately lead to economic collapse. Overall, Kiyosaki views on declinism reflect a broader sense of anxiety and uncertainty about the future that is prevalent in many segments of society. He encourages people to be proactive and take control of their financial future rather than relying on government programs or other external factors. The last two cognitive biases are the most complex to work with and to get rid from because they are directly connected to ego, wealth, greed, regret, uncertainty, willing to fix the situation, and to deep belief in happy ending. I can say that they combine the properties of first two cognitive biases groups and have many other unique properties. 16th, loss aversion. Loss aversion is a cognitive bias of affect when the pain of losing is psychologically twice as powerful as the pleasure of gaining. The loss felt from money and any other valuable object can feel much worse than gaining the same thing. Later, you will understand why it is very important in investing and trading domains. 17th and the final one, the sunk cost fallacy or Concord fallacy. This is the one of the most important cognitive biases to be aware of for traders and investors. Sunk cost fallacy is our tendency to continue with endeavor we have invested money, effort, or time into, even if the current costs outweigh the benefits. And while the term sounds like a technical jargon, it's a common decision-making pitfall in both life and business. The sunk cost fallacy can describe trivial things like continuing to watch a boring movie you've purchased, or more serious matters like refusing to pull out of a falling business investment, or even exiting from a detrimental trading deal. In common terms, the sunk cost fallacy is often called throwing good money after bad. This is the one of the most complex cognitive biases to work with because it impacts directly on your brain state by switching neural pathways in the moments of high emotional tension, and even can completely disable neocortex, which is mandatory for rational thinking system. This is often leads to making decisions under emotions, acting irrationally, IDEST using fast thinking system, or even can lead to activating of denial defense mechanism when your system 2 IDEST consciousness is completely off, but emotionally you do not realize the losses and freeze for a while in high tension state. Soon we launch the learning program where we study to work with these cognitive biases which rise when you experience high tension, anxiety or resistance during your operational activity. In this program you will learn how to work with hard emotions and avoid complex cognitive biases chains such as sunk cost fallacy and hard hand. And also I will provide you the tools to work with your behavior and habits by yourself during investing or trading process. Thank you for watching. Like and subscribe to see more interesting content about psychology and neurophysiology for life and business.